last objective in Chapter 29, Objective 3. Discuss how the Fed conducts monetary policy using the three tools of conventional monetary policy. The three tools of conventional monetary policy are 1. Discount lending at the discount rate, B. Reserve requirements, C. Open market operations at the Fed and the Fed funds rate, which is the most important of the three. And finally, we'll try to understand the complexity of monetary policy, and we'll discuss the yield curve and the Taylor rule. The conventional tools of monetary policy. So first, we're going to discuss the discount rate. The discount rate is basically where banks go to borrow money from the Fed. So we say they borrow at the discount window. If you lower the discount rate, you make it cheaper for banks to borrow from you. And when the banks borrow money from the Fed creates reserves for them, and that injects reserves into the banking system, and more loans can be made. And then through that money multiplier process that we talked about, the money supply can expand. So remember that the goal of monetary policy is to either expand the money supply if we want to shift the aggregate demand curve to the right, or contract the money supply, raise interest rates, and shift the aggregate demand curve to the left if the economy is overheated or we are worried about inflation. If you need a review of those topics, go back and look at the video lecture on aggregate demand, aggregate supply, and monetary policy. Another way that the Fed could potentially change the money supply is by changing the reserve ratio. If banks are lending everything that they are allowed to lend, then the actual reserve ratio will be equal to the required reserve ratio. So if the Fed were to lower the required reserve ratio, banks would have more reserves to lend, they would make more loans, right? And that would lead to more deposits in the banking system, and we know that deposits are a component of the money supply, M1, and so that could potentially expand the money supply. The last one we're going to talk about is open market operations. This is really the most effective and the most important of the three conventional tools for monetary policy. With open market operations, the Fed stands ready to buy and sell treasury bonds in order to either destroy or create reserves in the banking system, and then those reserves are lent out, spent, redeposited, and through the money multiplier process that we've already talked about, money is created. In fact, we learned in a previous video that the primary policy making body of the Federal Reserve System is called the Open Market Operations Committee. And that just signifies that this is really the most important of the three conventional monetary policy tools. So again, briefly, borrowing from the Fed and the discount rate. If there's a shortage of reserves, banks can borrow reserves directly from the Fed. Now, when we talk about the discount rate, we're going to talk about another market where banks can borrow and lend reserves from each other, and that's called the Fed funds market. Typically, the Fed prefers that if a bank needs reserves in order to meet their reserve requirements, that they borrow from each other rather than from the Fed. So I've already talked a bit about the role of the Fed as a lender of last resort, and if the Fed is going to make loans to a bank that's in trouble, in other words, no other bank is willing to lend to that bank, then that bank that is in trouble will be able to borrow from the Fed at the discount window, and the interest rate that they pay will be the discount rate. Changes in the discount rate are largely symbolic and follow changes in the targeted Fed funds rate. So the discount rate then is the interest rate that the Fed charges for loans that it makes to banks. And again, I want to be clear that the Fed prefers that banks borrow and lend reserves from each other in another market, and that market is called the Fed funds market. So typically, borrowing at the discount rate from the Fed is something that the Fed does for banks that are in trouble and they're in a situation where other banks are unwilling to make loans to them. So then an increase in the discount rate would make it more expensive to borrow from the Fed and may decrease the money supply, and a decrease in the discount rate would make it less expensive to borrow from the Fed and may increase the money supply. So changes in these discount rates tend to follow the Fed funds rate that the Fed is targeting as their key short-term interest rate. The reserve requirement. We've already talked about the reserve requirement, R, and we know that the reserves that banks hold are equal to the reserve requirement plus the excess reserves that banks hold on to, even over and above and beyond what they're required to hold on to by the Fed. Okay, so here we're going to think about the reserve requirement R as the percentage of that the Fed sets as a minimum amount of reserves that a bank must have, and that's expressed as a ratio of dollar reserves to deposits. We learned that the money multiplier is 1 over R, 1 over the amount of reserves that banks hold on to. Thus, the Fed can increase the money supply by decreasing the reserve requirement. Why? Well, of course, because that increases the money multiplier. The Fed can decrease the money supply by increasing the reserve requirement. Of course, that will decrease the money multiplier. Now, in order for these two policies to work, it has to be the case that the bank is not holding on to any excess reserves. So if R here is the sum of what banks are required to hold on to, plus they're holding excess reserves because they don't want to lend out, they want to hold on to more reserves in order to play it safe, let me put it that way, then you can lower the legally required reserves all you want, but that may not lead to more lending on the part of banks. And in fact, this is what happened during the financial crisis in 2008 and 2009. Banks started to hold on to a lot of excess reserves. So they were holding on to reserves in excess of what the Fed required them to hold on to, which I told you in class is about 10% of their deposits. Why? Well, they were nervous about making loans to businesses. They were nervous about making loans to households as households found themselves upside down on mortgages and their wealth decreasing rapidly as housing prices dropped. And they were really nervous even about lending to each other. And they were nervous about lending to each other because they had all these toxic assets on their balance sheets and nobody could figure out how safe the banking system itself was. And so in a situation like that, you could tell banks that they don't have to hold on to any reserves, and they might hold on to reserves anyway. And in that case, changing the reserve requirement is not going to be a very effective tool of monetary policy. So really the most effective tool of monetary policy is what we call open market operations. In fact, the open market operations is the key committee, the key policy making committee at the Fed. We've seen that in a previous video. So open market operations are the primary way in which the Fed changes the amount of reserves in the banking system, and that increase in reserves in the banking system then creates new money through that money multiplier process. So I told you the Fed is able to manage their liabilities directly, and by managing their liabilities, they indirectly manage the amount of money that's in the system through a process that links their liabilities to the money supply through the money multiplier. And it's really a pretty complex process that the Fed doesn't have direct control over. Then those changes in the money supply lead to changes in short-term interest rates and hopefully changes in long-term interest rates and interest rates like the prime rate at which people and businesses borrow money. And then changing the interest rate is, of course, a way of stimulating or slowing down the economy. So with open market operations, right, what the Fed is going to do is they're going to buy government securities. So I told you when we looked at the balance sheet for banks that one of the assets that banks hold on to is government bonds. And that happens to be an asset that the Fed holds on to as well. The Fed holds a lot of treasury bonds. And they can buy and sell those bonds in order to create and destroy reserves in the banking system. So you can imagine that if the Fed were to go out and buy bonds from banks, they would have to pay the banks for those bonds that they have purchased. How do they pay for those? Well, they pay for those by creating reserves for banks in the banking system. And then once the banks have those reserves, they can lend those reserves. And then when those loans are made and the money is spent, then it gets redeposited, or at least some of it, in the banking system, and those deposits count as M1, part of the money supply. And this process continues to the money multiplier process that we detailed in class. So if the Fed wants to expand the money supply, they're going to buy government securities. And if they want to contract the money supply, they're going to sell government securities. And they'll take payment for those government securities through bank reserves. They'll lower the amount of reserves in the banking system. And then banks will have to call in loans, and the money supply will contract, right? Everything that we talked about in class when we expanded the money supply will work in reverse, and the money supply will decrease. So again, just to be clear about what the open market operations look like in terms of expansionary and contractionary policy, to expand the money supply, lower the interest rate, and stimulate the economy, the Fed buys bonds. So expansionary policy is the Fed buying bonds. Again, buying bonds, paying for those bonds by creating reserves in the banking system, and then those reserves working their way through the banking system through a money multiplier process that creates money, right, lowers interest rates and stimulates the economy. To decrease the money supply, the Fed does the opposite. To decrease the money supply, a contractionary monetary policy, the Fed will sell bonds. And when they sell bonds, say to a bank, they'll take payment for those bonds out of reserves. So they'll contract reserves in the banking system. Banks call in loans. They can't make as many loans as they did before. And then a contraction in the money supply follows, and an increase in the interest rate, which would lower aggregate demand. Okay. So here's a graph of the Fed funds rate and the discount rate. And I told you previously that the Fed funds rate, when we move the Fed funds rate, that's largely symbolic and in step with what the Fed would like to do in terms of targeting what's called the discount rate. Okay, so the Fed funds rate is an interest rate that's determined in a market for overnight lending between banks. So at the end of every day, banks have to look at their deposits, and then they compare their reserves, the amount of reserves that they're holding relative to the deposits, and they decide whether or not they're meeting regulations or holding the amount of reserves that they desire to hold. And if they'd like to hold more reserves overnight before they close their books for the day, they can go to this market called the Fed funds market, and they can borrow those reserves from other banks. Okay? And banks who have excess reserves, more than they want to hold, can earn a little bit of interest by loaning those reserves to banks who want to borrow the reserves. So there's a market that's made here for very short-term overnight lending of reserves between banks. And the interest rate in that market is called the Fed funds rate. And that is the interest rate that the Fed directly targets with its policy. Okay? And movements in the discount rate, right, where banks would do the same type of borrowing lending but directly from the Fed rather than from each other in the Fed funds market, that change in the discount rate is in step, you'll see, with changes in the Fed funds rate. Here's what it looks like. There's a time series of the Fed's discount rate. Right, what that shows me is sort of what the Fed is thinking in terms of its target for the Fed funds rate. And here's a graph of the Fed funds rate which follows that discount rate very closely. Okay, that's a graph, a time series of the Fed funds rate. Okay, you can see that recently the discount rate has been slightly above the Fed funds rate. That discourages banks from borrowing from the Fed and encourages them to borrow from each other unless they need a lender of last resort. So I've already alluded to this, but basically monetary policy is complex. I mean, think about all the different things that have to happen for monetary policy to work and be effective. And I think monetary policy is effective, but it's not an exact science, let me put it that way. So here's what has to happen. Basically, remember that the Fed is responsible for stabilizing prices and finding an acceptable unemployment rate or acceptable employment. So what they want as a target is they have a number of different targets that they're trying to hit. Primarily, they're really looking at stable and predictable inflation at about 2% and an unemployment rate that's close to the target rate of unemployment, right? And good monetary policy is consistent with sustained long-run economic growth and moderate long-term interest rates, which encourage long-term investment. So the way it works is that way back here at the beginning of the process, the Fed has these tools that they can use in order to manipulate the liability side of their own balance sheet and create and destroy reserves in the banking system. And we just learned about those three conventional monetary tools. Open market operations here is listed first because that's by far the most important Fed policy tool for manipulating the liability side of their balance sheet. Then we know that once they manipulate the liability side of their balance sheet by changing the amount of reserves in the banking system, banks will have either more or fewer reserves that they can lend. More reserves means an expansion of the money supply, and less reserves mean a contraction of the money supply. Right? And they do all of this with an operating target, and their short-term operating target is the Fed funds rate. That's that interest rate that's determined in the overnight market where banks borrow and lend reserves from each other. Ultimately, we would like changes in that very, very short-term interest rate to have an impact on the Fed's intermediate targets. Those intermediate targets include things like consumer confidence, stable stock market, interest rate spreads, and housing starts. So they're looking at these intermediate targets to look at the health of the economy. If they think the health of the economy is staggering, they'll go back to step one perhaps and use open market operations as a way of expanding the money supply and stimulating the economy. If they think that the economy is overheating and that there are inflationary pressures, they will go back and use a contractionary monetary policy. Of course, ultimately, their targets are stable prices, right, and an acceptable level of the unemployment rate close to or at the target rate of unemployment. So all of these things have to happen through the short-term Fed funds rate influence on longer-term interest rates, which I'm going to talk more about in just a minute. So there are two rules I'd like you to know about, or I guess two more topics I would like you to know about. First, economists have tried to figure out if there's some type of underlying rule that the Fed uses to establish their target Fed funds rate. So now I'm going to talk a little bit about how the Fed targets that very short-term interest rate in overnight bank borrowing and lending of reserves. Okay, and economists have figured out that the Fed's ultimate target for the Fed funds rate typically follows a rule such as this: set the Fed funds rate at 2%, okay, plus current inflation if the economy is at desired output and desired inflation. So in other words, let's say that you were right on trend and you were right at the desired level of inflation, then you would set the Fed funds rate at 2% plus the 2% current inflation, which is equal to desired inflation, and you would want a Fed funds rate of 4%. Now, it gets a little bit more complicated if we're not on trend. If the inflation rate is higher than desired, you would increase the Fed funds rate by 0.5 times the difference between desired and actual inflation. And then also you would adjust your target Fed funds rate if output is higher or lower than desired. If output is higher than desired, increase the Fed funds rate by 0.5 times that percentage deviation. And of course, if current output is lower than desired, you're going to lower the Fed funds rate by 0.5 times the percentage deviation to stimulate the economy. Everything I have in this paragraph can be summarized in a simple equation. Here it is. The Fed funds rate equals 2% plus current inflation plus 0.5 times actual inflation minus desired inflation plus 0.5 times the percentage deviation of aggregate output from potential. So I'm going to put this rule to work for you and see if we can't figure out what the Fed's ultimate target this year might be in terms of the Fed funds rate. So let's review some current events here, okay? Here I'm just going to restate the Taylor rule as it was stated at the end of the last slide. And I've gone and I've looked up the current situation. What we know is that last week the Federal Open Market Committee met and they raised the target Fed funds rate to a range in between 1.5 and 1.75%. So they've increased the Fed funds rate. Ultimately, how far are they going to raise the interest rate this year? Well, in their statement after the Federal Open Market Committee meeting, they indicated that they're a little bit more worried about inflation than they were the last time that they met. And if inflationary pressures keep up, they're likely to raise short-term interest rates more aggressively this year than they had planned on previously. So they may raise interest rates more times, and they may raise interest rates a higher amount each time they raise interest rates. Okay, so here's the current economic situation. Right now, inflation is at 2.2%. That's based on the Consumer Price Index that's constructed by the Bureau of Labor Statistics. Now, I don't know exactly what Taylor rule the Fed might be following, but I've used what's called Okins rule of thumb in order to get a guesstimate of the percent deviation of GDP from potential. And I've guesstimated that at 0.4%. And the way that I got to that was by listening to what Jay Powell has said about his views of the target rate of unemployment, which he believes is in the low to mid 4% range, 4% to 4.5%. So I said, well, maybe the Fed is using a target rate of unemployment of 4.3%, and right now unemployment's at 4.1%. So that's a 0.2% deviation, right, from the target level of unemployment. And then there's this rule called Okins rule of thumb, which says, well, take that 0.2% and double it to get the deviation that we are from potential output. So that would be 0.2. If I double that, that's 0.4%. So right now I'm guesstimating that the economy is operating at about 0.4% above potential GDP. And I know that the target level of inflation for the Fed is 2%. They've stated that. So I'm going to take all of these numbers and I'm going to plug them into the Taylor rule in order to get sort of an upper limit as to what I think the Fed might be targeting ultimately this year in terms of a Fed funds rate. Okay, so the Fed funds rate then would be that 2% plus the current inflation rate plus 0.5 times the deviation between current inflation and desired inflation plus 0.5 multiplied by the percentage deviation of output from potential. I just plug it all into the equation and I come up with 4.5%. So according to the Taylor rule, we might think that ultimately the Fed is going to continue to raise the Fed funds rate and interest rates when they meet up to about 4.5%. And how long will it take them to get to 4.5%? That depends on how strong they think inflationary pressures are, what the impact of the tax cut might be, what the impact of Trump's tariffs might look like in terms of both inflation and the impact on employment and unemployment. That is the Taylor rule. The yield curve is a relationship that economists look at very carefully, both policymakers at the Fed and academic economists like myself and people in investing. The yield curve basically is what's called the term structure of interest rates. And all we do is we take the interest rate, we plot it on the vertical axis, and we take the length to maturity and we plot it on the horizontal axis. So it's maturity against interest rates. And it shows the link between short-term interest rates and long-term interest rates. And the bonds that we typically use to construct a yield curve are treasury bonds. So we're going to look at a treasury yield curve. Okay, and the key to understanding the interpretation of the yield curve is a process that's called arbitrage, which I'm going to explain on the next slide. I'm going to do a little bit more mathematics that's in your textbook. You're not responsible for reconstructing the mathematics, but I'd like to show you what arbitrage looks like, and I'd like to show you some of the underlying theory behind how we interpret the yield curve. Okay. So the definition of arbitrage, which we'll see on the next slide in practice, is that it's the simultaneous purchase and sale of related assets in order to profit from price differentials. This is going to cause different strategies of investing in bonds to have the same expected yield. And that's going to allow us to construct a very particular interpretation of the yield curve. Okay, so we're going to tie in together short-term interest rates with long-term interest rates. And remember that the Fed is targeting short-term interest rates. Ultimately, they hope to influence the economy, and that's only going to happen if their influence over short-term interest rates translates to an influence over long-term interest rates. Again, complex nature of monetary policy. So here's arbitrage. I'm going to define three variables. I1 is a one-period interest rate. So if I invest $1 for one period, okay, then I am at the end of that one period, I am going to end up with 1 plus I dollars. Okay. I subscript 1 superscript F, the second interest rate, that's the expected one period interest rate in the future. So it's the expected one period interest rate 1 period from now. That's what the F means. The F means in the future. Okay, it's an expectation. I don't know exactly what the interest rate on a one period bond is going to be 1 period from now, but I can formulate some expectation of it. Okay, and that's what I sub 1 superscript F stands for. And I2 is simply the 2 period compounding rate of interest that I can earn from investing in a 2 period bond today. I can lock that in. I can lock in I2 by investing in a 2 period bond today. Okay, so I basically have two strategies if I want to invest over 2 periods. I can either invest in a series of 1 period bonds, earning 1 plus I sub 1 in the first period, and then taking all of that and rolling it over and investing it for what I expect to be an interest rate of 1 subscript I superscript F in the second period. Okay, or I can just buy a long bond. Okay, those are two different investment strategies. Either this rollover strategy, where I invest in 2 one-period bonds, or I take my same amount of money, I'm just going to use $1 here, and I take the long bond strategy, and I just invest it for I2, and I lock that in today. So what that implies is that this left-hand side of the equation is equal to the right-hand side of the equation, where the left-hand side of this equation is that rollover strategy. What I'm doing here with 1 plus I1 is I'm taking $1 and I'm investing it for 1 period today. Then I'm going to take that amount of money that I have at the end of period 1, and I'm going to roll it over into another 1 period bond, and I'm going to do that 1 period from now, and I expect to earn an interest rate of I sub 1 superscript F. So that's what I'm going to call the rollover strategy. Okay, that's rollover. I don't know if I can write that here or not. Roll. It's hard to write with this. Rollover. I'll just write roll. Okay, that's your rollover strategy. This strategy is your long bond strategy. Just buy a 2 period bond today, lock in that compounding rate of interest I2, and be done with it. Okay, so that's what we'll call the long bond strategy. And arbitrage says that these two strategies could give the same expected yield. Of course, because if one were to offer a higher return than the other, then you could take the strategy that has the lower yield, and you could borrow money using that strategy and turn around and invest the money that, that implies a higher yield, the other strategy, and make money. Right? That's what arbitrage is. You don't even have to have the money. You could borrow the money at the strategy that costs less, and go ahead and invest it in the strategy that has the higher yield and make money. And people like to make money, in a sense, for free, right? And this arbitrage opportunity would be an opportunity to do just that. And what it implies is that we can't be in equilibrium until interest rates adjust so that this equation holds exactly. That's arbitrage. So I'm going to use this equation to motivate an interpretation of the yield curve. Okay? So a little bit of algebra, not much. Okay? That's arbitrage. That's my arbitrage equation. And so I'm going to start by rewriting this equation. There's a rule from math which basically says that if I1 and I sub 1F are very small, then 1 plus I1 times 1 plus I1 superscript F is approximately equal to 1 plus I sub 1 plus I sub 1F. And likewise, 1 plus I sub 2 squared would be approximately equal to 1 plus twice, 2 times rather, I sub 2. And I subtracted the 1's from both sides, and you immediately end up with this equation. Okay. It's based on an approximation, but these two equations are approximately the same thing, as long as our interest rates that we're dealing with are relatively small. So what I'm going to do now is I'm going to take this equation that I have derived from my arbitrage equation, and I'm going to solve it for I2. Here it is, okay? So I solved this for I2. So remember what my yield curve is going to be. We're going to look at a real yield curve in a minute. But what I have down here on my horizontal axis is time, okay? The number of periods that are going by before the bond matures and pays off its face value. What I have on the vertical axis is I have the yield on the bond, okay? And what I'm going to plot here is I'm going to plot, for example, for a 1-period bond. There's 1 period. I'm going to plot the interest rate, right? So I'm going to have on the vertical axis for a 1-period bond is I'm going to have I sub 1, okay? And then I'm going to go 2 periods out, and I'm going to plot I sub 2. Let's say that I sub 2 is greater than I sub 1. It doesn't have to be, but let's say that it is. Normally it is slightly higher. Okay, and then I connect those two things together here, and I would get an upward sloping yield curve. And I want to be able to interpret what I sub 2 means in terms of its prediction of what's going to happen to short-term interest rates. So it should be clear to you from looking at this formula that if I sub 2 is in fact greater than I sub 1, it implies that expected future short-term interest rates are higher than current short-term interest rates. So the interest rate on a 1-period bond that I expect in the future will be greater than the current short-term 1-period interest rate if I2 is greater than I1. That's just a simple property of taking this average. And likewise, if I were to plot an inverted yield curve, a downward sloping yield curve, then I2 would be less than I1, and that would imply that markets seem to expect that short-term interest rates are going to fall. So when do short-term interest rates tend to be on the rise? Well, short-term interest rates tend to be on the rise when the economy is growing and it's reasonably healthy and the Fed is raising interest rates because they're worried about inflation and they're not particularly worried about the unemployment rate. So a slightly upward sloping yield curve is sort of a normal yield curve, and it suggests that financial markets believe short-term interest rates will be rising moderately over time, and that the economy is in pretty good footing and is reasonably healthy, right? When the yield curve flattens out, or when it becomes inverted, that's basically the market telling us that they expect short-term interest rates to fall. When do short-term interest rates fall, implying an inverted or downward sloping yield curve, right? A yield curve that would be shaped like this instead. Well, when the markets expect that the Fed will be cutting short-term interest rates and targeting lower short-term interest rates because the economy is in trouble. So when the yield curve flattens out or inverts, it's usually a signal that markets expect that the economy is going to end up in trouble sometime soon. So there's this strategy of sort of riding the yield curve. You know, if the yield curve is upward sloping and looks like short-term interest rates are going to be rising moderately over time, then stay invested in the stock market, you know, and maybe have some money in bonds, right? And then if the yield curve inverts and you expect short-term interest rates to be falling, that means that the economy is going to be, you know, heading into some trouble. Remember that as interest rates fall, bond prices rise, so that would be a good time maybe to switch over from stocks, which don't do as well when the economy is in turmoil, into bonds where when their interest rates are falling, the price of them is increasing, and you can earn some capital gains in the bond market. That type of investing strategy is called riding the yield curve. So here's a couple of different yield curves, okay? The first one is a yield curve that looks normal, slightly upward sloping, right? This means that we know now that markets expect short-term interest rates to be rising moderately over time, and the market thinks that, you know, that the economy, the state of the economy is going to stay reasonably healthy. When the yield curve, right, or the yield spread, when it inverts, becomes downward sloping, we know that the market now expects that short-term interest rates in the future will be falling below what they are today. And that could be a sign that the economy is headed for trouble. Okay, I'm going to show you now, in order to end this lecture, a video called The Living Yield Curve, and I want to kind of just watch this with you. And in order to watch this, I need to turn off my pointer. I think I just click on that to do that. So on this website, you can see what's called a dynamic yield curve, which is based on U.S. government securities, which is typically the way we construct yield curves. So let's let this load up. Hopefully it will work. My internet seems to be working okay here at home today. It's a little slow. That's okay. So here it is. What I'm going to do is I'm going to play this. I want you to see what's happening to the stock market over here on the right. And I'm going to animate this. I'm going to actually show you what the yield curve looks like over time. Right now, this is set to March 26th, 2018. So literally just one day ago. It was updated yesterday. But when I hit animate, it's going to go back in time, and it's going to show you the yield curve. And I want you to watch for the points where the yield curve flattens or inverts. Those will be key dates where we've had economic crises, you'll see. So here's an animation. It starts in 1999. And the economy is doing pretty well. That yield curve, right? That yield curve is it's upward sloping. The markets here are expecting pretty decent things from the economy. Now we're coming into 2000. Boom, it inverts, and we know there was a recession in 2000. So there's the recession of the early 2000s with the dot-com bust. Okay, the Fed's lowering interest rates, trying to stimulate the economy and setting us up for potentially the next economic crisis. The economy recovers. Nice, strong, upward sloping yield curve there. Now we're in the 2000s and the economy has recovered. The stock market's still falling, but it's going to recover as well here. As the economy moves into 2002, the stock market starts to recover. Upward sloping yield curve. The economy is continuing to expect good things. The markets are continuing to expect decent things from the economy. 2003, it stays upward sloping. You can see the stock market rising on the right. Continue to watch this until we get to about 2007. When we get to about 2007, we're going to expect markets, or the yield curve is going to start to flatten and maybe even invert, as markets really expect economic crisis and they expect short-term interest rates to be cut. Here it starts to flatten. And it's flattening well before the financial crisis, and people recognize it. Look at that. 2006 is really starting to flatten out. Right? This is a good leading indicator of the economy. We're coming into the beginnings of the financial crisis here. We're in December 2006. Now we're into 2007, when the yield curve is already flattened out on us. Right? It's upward sloping again. Markets aren't sure what's going to happen. Okay? And then, boom, the Fed really starts to cut short-term interest rates. So you saw it flatten before the financial crisis in 2007. And what you can see here is the entire yield curve shifting down with what we're going to learn about later, called quantitative easing. And you can see the Fed on the intersection of the yield curve on the vertical axis aggressively cutting short-term interest rates all the way down to 0%. Hopefully you can see that down here with 0%. That's what the Fed's doing. That's just immediately cutting interest rates down to 0%. The stock market's now recovering. The yield curve is upward sloping. By now we're in 2011. The worst of the economic crisis has passed us. The economy is back into a slow expansion, but financial markets expect a continued recovery here. And in fact, there has been a continued recovery all the way through the year 2018. And so I can come all the way. We can continue to let it move all the way to today. We're in 2014 now. The stock market continues to climb. We're going to get all the way up to, the recent volatility in the stock market due to uncertainty about both the government budget and the lifting of spending caps, the likelihood of an increased budget deficit, and of course the uncertainty that surrounds the tariffs that the Trump administration has been unilaterally imposing on our trading partners. So you can see the Fed now starting to raise interest rates here. Look at the axis here. Okay, we're going to see that rise up to about 1.5 to 1.75%, the current Fed funds target. The drop in the stock market in the last couple of days, okay, and then the whole thing starts over. So that's the yield curve and how we interpret it. Really handy to know about the yield curve.